Okay, welcome to day 2 of me studying for the SIE exam. Today I went over section 3 and most of section 4 of the Kaplan SIE study book, and so I'm using that as my basis for my studying. So the first thing that's covered in section 3 is it's all based on derivatives. The primary derivatives we're talking about are going to be options, primarily stock options or equity options, but there are a couple other kinds of options that are covered as well. A derivative just means it's a contract that derives its value from an underlying asset, usually a contract to buy or sell an underlying asset. In our case, it's usually just a form of security, but there do exist commodity derivatives, and those are referred to as futures. Those aren't covered by the SIE exam. They're a bit different. So an option, it's a two-party contract. There's a buyer and a seller. There are two kinds. There are calls and puts. There's a long call, which is a purchase. It's a right to purchase an amount of shares at a given price before a certain time. Short is where you're selling, where you're obligated to sell a certain number of shares at a given price if the buyer exercises the contract. There are also puts, which is the kind of the reverse. It's the right to sell an amount of shares of a given stock at a given price before some contract expiration. And then there's also a short put, which is the obligation to buy. So these are in pairs. A call and a put are opposites of each other, and on each one there are two sides to the agreement. Okay. So then we have being in and out of the money with these things. If you're in the money, it means that the price of stock exceeds the strike price, meaning that you're good to go. At the money, these are for calls, sorry. Calls at the money, the price is equal to the strike or settling price, the agreed upon price in the contract. And then out of the money, the price is below the given target price, the strike price. The intrinsic value is just how far into the money the contract is multiplied by the number of shares. And then parity is when the intrinsic value of it is equal to the premium paid. In order to have one of these options happen, someone has to pay the other. The person buying the contract has to pay the seller a premium for the right to do either the buying or the selling, depending on whether it's a call or a put. For puts, in the money the price is less than the strike price, so you can buy, you can sell a stock when the normal price is below the market price. When the strike price is higher than the market price. Anyway, at the money, strike price and market price are the same, and out of the money, the market price is higher than the strike price, so you wouldn't sell. You wouldn't exercise your option to sell. Intrinsic value is how far into the money it is, once again, and then the parity is whether the intrinsic value is equal to the premium. So there are non-stock or non-equity options. You can have index-based option. No, you can index-based options, as in either broad-based, like a whole stock exchange or a stock index reflects a larger slice of the market. Or you could have narrow-based, which is an industry. Say you just focus on mining or even more narrow, gold or tech companies or pharmaceutical companies. Those would be, if you're buying options in those, that would narrower index, like a narrow slice of the market. So index options settle based on the price at the close of the day. So if the index jumps real high but then settles back down by the end of the day, it settles where it is at the end of the day. Same if it drops, it just where it ends the day is where it settles. So keep that in mind. So everyone keep that in mind when you're dealing with index options. There are also currency options. Oh yeah, index options settle in cash, not in equity. That's another thing to note. So anyway, interest rate options, they're yield based. They also settle in cash. And they typically track the Federal Reserve Treasury bond, T-notes, T-bonds, and T-bills. Yeah, that's the third one. If you're buying a call or writing a put, you think the rates are gonna rise. If you're writing a call or buying a put, you think the rates are going to fall. Okay. And so on these ones, they only, on interest rate options, they can only be exercised on the expiration date of the contracts, which is referred to as European style, and the American style is at any point during the contract you can exercise your options. So you can choose what you think is the best day to exercise the option and go boom right then. Or European style is like, at this date, the options are going to be either exercised or not. You can't choose an intermediate date. So one should keep that in mind. There are also currency options. There are a select number of currency options that are traded on U.S. markets. Also exercised European style. It's mainly to hedge against currency volatility for exporters and importers. So if you're an exporter, you should buy puts in the currency where you are selling your goods to. And if you're an importer, you should buy calls on the currency where you are importing from, because it's all about changes in how much the money you either spend or receive is going to buy you. So there's, but yeah, all options expire on the third Friday of the month. So if an option is expiring on Friday, so if it's ending on, so if the option is ending in January, it ends on the third Friday of January, third Friday of February, etc., etc., etc. Okay. You calculate options based on a bunch of things. There's the break-even price, which is this, depending on how it goes, like, it's how much money you paid for the premium, and then what the price of the stock has to be to make it so you break even on the transaction. And then there are maximum gains and maximum losses. Typically, if you buy a contract, the maximum losses are just the premium paid. So, because you buy the right to exercise the option, so you're at most only out the premium you pay if the option doesn't go your way. And typically these are used as a hedge anyway. We'll get into that in a little bit. Well, actually, yeah. So you just calculate. It's basic math. You just calculate these. Think, if I do this, how much money am I going to lose? Like, if you need to, you can take the time to just write it down on paper or something. It's not that crazy hard to calculate maximum and minimum losses. Hedging, There are different ways to hedge. You can calculate the break-even price, which is if you're dealing with a protective put, where you're like, I want the stock to go up, but in case it goes down, I kind of want to just make sure I'm not gonna lose all my money. So the break-even point for a protective put is the stock price that you initially bought in at plus the premium. So if the stock price goes up higher than the premium does, then you're golden. A protective call is if you're shorting a stock, but you don't want to lose the potentially infinite amount of money. And the break-even price is if the stock price is the stock price that you initially shorted at minus the premium, because you want to go further below the premium. So you want to drop, $3 or whatever. If you're paying $3 a share as your premium, you want the stock price to be $3 below where you started shorting it at to break even. So people often use options to generate income from the premiums. It's usually considered a relatively conservative thing to do if you write covered call options, like I already own the stock, I'm just going to write call options because, if nothing happens, if no one exercises their call rights, I just earned like this premium, and that's quite handy. Usually these premiums exercise monthly, so it's a great way to get some monthly income from owning a stock. It's relatively safe. So covered is when you already own the stock. There's also naked call options, which are quite risky because you'd have to buy the stock at the market price and then sell it at the dropping price. So that's pretty risky because you'll need to buy on the open market, which might not be great. Writing put options can be also pretty handy. If it's covered, that means you just have the cash on hand, and it's like, well, I've got this cash, a great way to just utilize these extra funds is just to write covered options, where if I really need to buy a stock at a certain price, I can just pay it out with the cash, but otherwise I'm just getting income on the money I own. And there's uncovered, which is kind of being a bit crazy, where you write put options and don't have cash readily available in your funds, and you have to kind of scramble the last day if someone exercises the option. So that's a bit risky. I personally don't have that kind of risk tolerance, so I wouldn't do it on my own. Covering against short stock, it's kind of a convoluted way of hedging. It's like you write a put option on a stock that you're shorting, so if it drops, you technically are covered in case it doesn't drop that much, but you're not really protected that much if the stock goes up, because shorting, like writing a put option while shorting a stock, is not necessarily the smartest thing to do. So yeah, typically if you're short a stock, you would write a call to or whatever. Or actually, I don't know. Anyway, if you're short a stock, you would do other things. That one's a bit convoluted, and it's just, I guess, a potential test question, so keep that in mind. Customers, in order to begin trading these, need to be approved by their broker to do it, and the broker's organization, and they also have to fill out the agreement. As soon as they're approved, they can start trading, but if they don't fill out and sign the agreement within a 15-day time period, they can only finish the contracts that they've already started. They can't start new ones. All these options are typically run by the OCC, or Options Clearing Corporation. That's the regulator in the United States. They're the clearing agent for all U.S. options exchanges, and they kind of determine all the rules and standards, like when you can trade, when things terminate, how you can exercise, what the auto exercise clauses are, and assigning like who gets what contracts. So contracts are usually assigned randomly by, like, people are paired up typically in stocks or with options, typically are paired up randomly, and that's done by the Options Clearing Corporation, or they determine how they're randomly assigned. Okay, that's the end of section 3. Section 4 starts covering packaged investments, and we got partway through this section today. You start with investment companies. It's typically investors pool their assets together to get more buying power or investing power in the markets. Like, one person with $100 can't buy a share of Apple and Tesla and Google. Like, you can only buy like maybe a fractional share somehow. It's not really going to be that easy to do. So that's where investment companies come in. There are 3 main types. 2 of them don't really exist that much anymore. Face amount certificates are pretty rare. There might be a couple in existence in the United States, but they're not super common anymore. You buy a certificate for some discounted price, and then at the end they're paid out at face value. It's kind of like buying a zero coupon bond, but it's not a debt, it's an investment vehicle, or an equity vehicle, theoretically. So it's more like a CD, actually, more like a certificate of deposit. So it's something kind of like that. A whole company being set up to do that is not super common anymore, but it's a thing that can exist. You have unit investment trusts. They either buy debt or equity, and fixed UITs. UITs can be fixed UITs. They end, and then there's a payout at a set date. And then there's the much more common managed investment companies. There are closed-end investment companies and open-ended. Closed-ended, there's an initial offering on an exchange of stock in this company, and they use those funds raised to invest in more ventures, and then afterwards those stocks are traded on secondary markets, like a stock exchange of some kind, between different people. And those can also issue preferred stock and debt securities as organizations. You also get open-ended, more like your standard mutual funds, where you buy into you can buy into the fund at any time. As you buy into the fund then has more. You basically purchase shares directly from the fund, so there's a continuous public offering of stock. And as you buy into the fund, they then invest the funds into whatever ventures they're using. And if you want to cash out, you cash out directly from the fund. And you cash out at net asset value, so like what percentage of your funds are you cashing out, and how much of the stock of the fund is that, and what's the value of that. So as you cash out, it doesn't affect other people's investments in the fund. It just affects, it doesn't, people buying in and cashing out doesn't affect other investors' investments in the fund. And so, yeah, that's what I got to tonight. thanks for watching. Hopefully this is helpful. I guess if anyone besides me is watching this, because it's mainly just for me. But yeah, thanks. Good luck.